Recessions don't arrive with a single headline. They arrive through signals, quiet shifts that show up months before the word recession appears on the news. If you want to track recession risk without watching every data release, there are 4 signals that matter most. The first signal is the labor market. Not because layoffs automatically mean recession, but because employment is the largest driver of consumer demand. When hiring slows, growth slows. And the earliest sign is rarely mass layoffs. It's hiring freezes. Job openings decline. Recruiting slows. Hours get cut. Companies stop replacing people who leave. This is the soft phase of labor weakening, and it often happens before unemployment rises. So, don't only watch unemployment, watch momentum. If job growth is slowing and hiring freezes spread across sectors, recession risk rises. The second signal is consumer stress. The economy can remain resilient until consumers begin pulling back. And consumers pull back when cash flow tightens. 2 metrics matter here: delinquencies and credit usage. When delinquency rates begin rising across credit cards, auto loans, or personal loans, it signals stress is spreading. When consumers rely more on credit just to maintain spending, it can look like strength, until it isn't. The point is direction. A small rise doesn't matter. A sustained climb does. Consumer stress often shows up before the economy breaks, because consumption is usually the last engine still running in late cycle periods. The third signal is credit spreads. Credit spreads are powerful because they capture fear early. Equity markets can stay optimistic for longer than fundamentals justify. But credit markets tend to reprice risk faster because lenders care about getting paid back, not growth stories. When spreads widen, it often means investors are demanding protection against defaults that haven't shown up in earnings yet. And widening spreads don't just signal risk, they create it, because companies refinance into higher costs. Banks tighten lending standards, weak borrowers get shut out of funding. And once funding dries up for weaker balance sheets, layoffs and capex cuts follow. That's how a market signal becomes an economic slowdown. Credit spreads measure how much extra yield investors demand to lend to riskier borrowers compared to safe government bonds. When spreads are tight, markets believe default risk is low. When spreads widen, markets are pricing higher risk. This matters because credit is the bloodstream of the economy. When spreads widen, borrowing becomes more expensive for companies. Companies then cut investment, they delay hiring, they preserve cash, and the slowdown spreads. Credit spreads are one of the best early warning indicators because they move before company earnings collapse. They move on expectation, and recessions are largely expectation-driven. Once risk is repriced, behavior changes, and behavior creates the slowdown. The fourth signal is the yield curve and interest rate expectations. A yield curve inversion isn't a perfect predictor, but it's historically one of the strongest recession signals. It occurs when short-term rates rise above long-term rates. That usually reflects a market belief that growth will slow and rates will fall later. But the yield curve isn't just a chart. It affects real-world lending. Banks often borrow short and lend long. When that relationship becomes unattractive, lending standards tighten. That reduces credit availability in the real economy. So the yield curve matters because it can influence bank behavior, not just market forecasting. Now here's the important part. No single signal guarantees recession. Recessions happen when multiple signals align. A labor market slowdown, consumer stress rising, credit spreads widening, lending tightening. That combination reduces demand and increases fragility. And once fragility rises, shocks matter more. An energy spike, a geopolitical event, a market sell-off, a policy mistake. In healthy conditions, shocks are absorbed. In fragile conditions, shocks spread. So how do you use this practically? If you see one signal flash briefly, you don't panic. But if you see 2 or 3 turning at once, you pay attention. Because recession risk isn't a binary event. It's a probability distribution. And probabilities shift when the underlying signals shift. The best way to stay rational is to watch direction, not noise. Labor momentum, consumer stress, credit spreads, yield curve, and lending conditions. These 4 signals will usually tell you whether recession risk is rising long before headlines catch up. The goal isn't prediction perfection. The goal is early awareness, because recessions don't surprise everyone. They surprise people who aren't watching the signals. And in macroeconomics, signals always move before outcomes.